review problem. It says calculate the minimum premium an insurance company should charge for a $5 million 3-year term life insurance contract issued to a man age 60. Assume the premium is paid at the beginning of each year and death always takes place halfway through the year. Risk-free interest rate is 6% per year with semi-annual discounting. Alright, first of all, here's the mortality table. And from this table, we determine that the probability that this man age 60 will die within the year is as shown here, which is 0.011858. The probability of him dying in year 2 will be equal to the probability of him surviving in the first year, which is 1 minus the probability of dying in the first year, multiplied by the probability of him dying within the second year, which is this value right here from there. So that gives us this result. Likewise, the probability of him dying in the third year is equal to the probability of him surviving in the first year times him surviving in the second year times him dying in the third year, which is this value right here. So this is our final answer. Alright, so to determine the expected payouts, we're going to be multiplying the unconditional probabilities we have obtained, this value, and this value, by the face value of the life insurance. And we show it here so that for the insurance to determine the expected payout should the man die in the first year, it'll be this probability of him dying in the first year multiplied by 5 million, and that's what you see calculated here, and this is the results. Likewise, to determine the expected payout were the man to pass away in the second year, it'll be this probability here. Remember, this value, if I go back, is obtained from here. That's this value right there, multiplied by 5 million bucks, and you'll get this. And finally, to determine expected payout in the third year, it'll be this probability multiplied by 5 million, and that's the result. So with that, we find the present value of the payouts. So actually, it's the weighted average of these payouts, by the way. Alright, so that's going to be the present value of this 59,290 discounted semi-annually. So assuming half year, it occurs right here. So we use the half rate. Remember, in the problem, rate of return is 6%. So semi-annually speaking, it'll be 3%. So that this 59,000 would occur right here, and it's going to be discounted over one period at 3%. The second amount, 64,000 and change, would occur right at this point, all right, which is in the middle of the third year. So that'll be discounted over 3 periods at 3%. And finally, for the third year, it'll be right in the middle, which is 5 periods from today. That's what you see here. So the present value of this comes out to be 175,598.6. Keep in mind that this can be, that what this amount really is the expected value of the payout. Expected value of the payout should actually be viewed as $5 million in the first year, discounted by 1.03 times the probability of 0.011858, this, plus the second $5 million discounted by 1.03 to the third times its probability of 0.01281225, and finally plus the third $5 million discounted by 1.03 to the fifth multiplied by the corresponding probability of 0.01377458. And when you do that, you'll obtain this thing. It's actually more insightful to do it in the latter way. So now, having determined the expected payout, next we determine the premium payments. Now, remember, for him to pay a premium, he's going to have to survive. The survival probability of the 60-year-old man would be 1 exactly for the first payment, because, as you know, payments are made at the beginning of the period. So once he signs the contract, he makes a payment. So the odds of him making that first payment are equal to 1. Now, though, the survival probability that would be connected with his second payment would be 1 minus the probability that he dies in the first year. So 1 minus the probability that he dies in the first year gives us the survival probability for the first year. So the odds that he's going to be alive to make the second payment is 0.988142. And for the second year, the probability of him surviving would be 1 minus the probability of him dying in the first year minus the probability of him dying in the second year. Now, remember, these values that you see here, respectively, if I go back here, you see them right here and right here. We already determined them to be the respective probabilities of him dying in the first and second year. So, and then we have these final results, the probability of him surviving in the first year, the second year, and in the third year. Now, we note here when the premium is X dollars per year, the present value of the premiums received would be equal to X times the probability of 1, which is X, plus X times this probability of him surviving in the second year. You know, we call X the premium. We're not going to give it a number, a value yet. So this is the probability times, or if you like, the premium to be received multiplied by the probability of receiving it discounted over 2 periods. Remember, payments are made at the beginning of each year. So in this case, this second premium would be made, if I were to, let's see, do I have any kind of drawing here? I should, right here. This, all right, so the first premium is made here, the second one here, the third one right here. Okay, so the second one would be discounted over 2 periods, and then this third one would be this premium to be received multiplied by the probability of receiving it to be discounted over 4 periods. Again, it's going to be paid received at this point. So from this period, from here to here, is a period of 4 years, and that's why this discounting is over 4 years. So factoring this whole thing out, as you see here, this comes out to be this value right here times X. So premiums are received at the beginning of each year, as I noted. Now then, the break-even annual payments, annual premium is X. Is the value X, that premium that will be paid, that'll set the present value of the expected premiums equal to the present value of the expected payout. So we're going to take this and set it equal to this expected payout we calculated earlier on right here. All right, and solving, that comes out to be 62,758.91, and that tells us straight away that that's going to be the break-even payments, the minimum payment below which it would not be a profitable insurance contract for the insurance company to sign, above which the insurance company would prefer, because it'll keep the insurance company financially strong and profitable. And that's it.